Hello, everybody, and welcome back to another episode of the Wealthologist Weekly. I am Chris Hobart, the Wealthologist, and today I wanted to talk with you about some fascinating economic data that's out there. We're going to be talking about the job market. I know, I just heard you start yawning because it can be a bit dry, but stick with me because there's actually some interesting twists and turns here that I don't think you're going to want to miss, and it helps us kind of understand the economy a little bit better. So let's start with the latest report that came out last week. Now, on the surface, things look pretty good. Non-farm payrolls were up more than 200,000 in June, which, got to tell you, that's a solid number. But I want you to understand something. This is where it kind of gets interesting. When we look closer at these numbers from the previous 2 months, they were revised downward, which means if we net that out, the total gain in total payrolls is actually just 95,000, with only 50,000 of those being in the private sector. Now, here's the weird part. Over the past year, non-farm payrolls are up by about 2.6 million. But civilian employment, which includes small business startups and things like that, it's only up by 195,000 in the total over the same period. Now, I want to reiterate that. It's not 195,000 per month, but for the entire year. That's kind of weird, right? Now, one possible reason for this gap is the recent surge in immigration. So immigrants who get jobs at companies included in the payroll survey, they're counted because these surveys are filled out by employers. Now, on the flip side, the civilian employment figures are based on a survey of individual households, and it can be kind of tough to survey new households or those who might be hesitant to fill out government surveys, especially if they're here illegally. Now, interestingly, this gap between the two surveys, while it's unusual, it's happened before. It was actually larger in the mid-1980s, the late 90s, in 2013, as well as during COVID. Now, another oddity is the consistent negative revisions to payroll reports over the past few years. For example, in 2022, the third report for payrolls averaged 6,000 less than the initial report. In 2023, this average revision was negative 30,000, and so far this year, it's been negative 49,000. Historically, these negative revisions are more common around recessions than during periods of strong growth. But there could be maybe a less alarming reason for this. You see, the payroll report is based upon employer surveys. And in the 10 years prior to COVID, the government got on-time response rates of 75% from employers. But the past 3 years since COVID, this rate has actually dropped to 65% on time. So companies that don't respond on time might be struggling more than others, which could skew some of this data and maybe not make it quite so apples to apples. Now, there's also a significant gap between full-time and part-time jobs. Civilian employment data shows that full-time jobs are actually down by about 1.6 million in the past year, while part-time jobs are up by 1.8 million. Now, typically, when we see a loss of full-time positions, that suggests a recession, not strong or robust economic growth. So the question is, do these anomalies mean that the government is cooking the books? Well, we're not going to go that far. No conspiracy theories here. Because if they were, wouldn't it kind of make sense that the civilian employment report would look a lot better? The thing is, it's more likely that officials may sometimes push a narrative that suits their purposes. And we've seen this in the past with different guidelines that have been put out there or other government reports. So the question you're probably asking is, where does that leave us? Well, we believe that the job market is somewhere between the strong picture painted by the payroll report and maybe the softer civilian unemployment figures. The thing is, there's no recession yet, but there are some early signs of what we would consider a slowdown, and those are what we are watching for from our side. Again, this data is always helpful in giving us guidance as to what's going on, but at some points, it can be a cloudy crystal ball, as so many of you know. All right. I want to thank you again for tuning in to this week's episode of the Wealthologist Weekly. If you found this information helpful or insightful, do me a favor. Like it, subscribe to our channel, pass it on to some other folks, and also let us know in the comments what topics you would like to cover next. Until next time, I am Chris Hobart, the Wealthologist. helping you make smart financial decisions. Have a great rest of your week.